The fifth learning objective is to classify assets and liabilities as current or long-term. Assets and liabilities are classified either as current or long-term to show their relative liquidity. Liquidity measures how quickly and easily an account can be converted to cash, because cash is the most liquid asset. Accounts receivable are relatively liquid because receivables are collected quickly. Supplies are less liquid, and furniture and buildings are even less so because they take longer to convert to cash. A classified balance sheet lists assets in the order of their liquidity. Current assets will be converted to cash, sold, or used up during the next 12 months, or within the business's operating cycle if the cycle is longer than a year. Current assets are items that will be used up in a year, like your notebook paper for this class or the change in your pocket. The operating cycle is the time span when, number 1, cash is used to acquire goods and services. These goods and services are sold to customers, and the business collects the cash from the customers. For most businesses, the operating cycle is a few months. Cash, accounts receivable, supplies, and prepaid expenses are current assets. Merchandising entities have another current asset, which is inventory. Inventory shows the cost of goods the company holds for sale to customers. Long-term assets are all the assets that will not be converted to cash within the business's operating cycle. One category of long-term assets is plant assets, also called fixed assets or property, plant, and equipment. Land, buildings, furniture, and equipment are plant assets. Other categories of long-term assets include long-term investments and other assets, a catch-all category. Current liabilities must be paid either with cash or with goods and services within 1 year, or within the entity's operating cycle if it is longer than a year. Accounts payable, notes payable due within 1 year, salary payable and interest payable, and unearned revenue are all current liabilities. All liabilities that do not have to be paid within the entity's operating cycle are classified as long-term liabilities. Many notes payable are long-term, for example, a mortgage on a building. A classified balance sheet classifies each asset and each liability as either current or long-term. Using the previous example, the company's classified balance sheet is shown. Note that there are headings for the current assets, plant assets, current liabilities, with subtotals for each. Long-term liabilities appear beneath current liabilities. A balance sheet that lists the assets on the left and the liabilities and equity on the right in an arrangement is known as the account form. There are two formats for the balance sheet. The balance sheet that lists the assets at the left and the liabilities and equity at the right is an arrangement known as the account form. A balance sheet that lists assets on the top and liabilities and stockholders' equity on the bottom is an arrangement called the report form. Although either form is acceptable, a report form is more popular. Short exercise 4-9 classifies assets and liabilities as current or long-term.